Welcome to Know Your Options, the Measured Risk Podcast.
The ultimate guide to navigating the volatile nature of the markets while managing risk purposefully.
Join us as we challenge the theory behind traditional asset allocation and dive into the mathematics of investing.
Whether you are a seasoned investor or just starting out,
this podcast offers valuable insights and practical advice to help you make informed decisions and manage your money wisely.
So grab a cup of coffee, sit back, and let's dive into the world of calculated risks together.
Well, hello, everybody. This is Larry Kriesmer with the Know Your Options podcast, and I'm here today with a different kind of guest, Rick Rosenthal. He's with Cboe, the Chicago Board of Options Exchange Director. Welcome, Rick.
Thank you very much, Larry. Appreciate you inviting me.
You bet. So I know you're a director of something, but it had a long title. So why don't you explain what it is that you do and what your role is with the Cboe?
Sure enough. So I've been with Cboe. I started in 2015. I'm a seasoned professional, been in the industry for about 40 plus years. And my role at Cboe has transitioned. Originally, I was a product expert in the FTSE Russell index options. And today, my focus is primarily helping advisors understand the benefits of using options-based strategies. They don't have to be the experts, but they have to understand as fiduciaries how to communicate to their clients the ability to maybe generate income, manage downside risk, or enhance risk-adjusted returns with well-defined options-based strategies. So my role is helping the advisors understand these solutions, and then if we can help them along the curve, we'll help them implement those strategies, introducing them to potential sub-advisors and 40 Act funds.
Awesome. So what do you think is the most common strategy that is an option-based strategy that's being deployed out there right now?
Sure. Without a doubt, most financial advisors that are comfortable with options start off with a covered right. They have a client that has a concentrated stock position, and typically that's an emotional holding that the client does not want to sell. And the advisor can actually generate some incremental returns selling an out-of-the-money call. So in other words, the client holds onto the stock and they sell a call that's above the market. The premium that's collected from the sale of the call becomes a source of income. And this is actually done on a risk-free basis. In other words, the client owns the stock. They're not expected to sell it. They sell the call above the market. If the market does by chance go up to the strike price, there is a chance that the call could be assigned. So selecting the appropriate strike is key. And so that's a very popular strategy for the advisors that are new to using options.
Yeah, I think it really is a common kind of almost conception that if you use options, that's what you're doing. That's all you're doing. One of the things that we have here at Measured Risk Portfolios is trying to avoid getting put into that bucket, because we actually don't do covered call writing here. I mean, it's done for some clients on a one-off basis, but the core strategy doesn't do that. But it is really what I would say the general advisor population thinks about when they think about options. So it's interesting too. Whenever I get pushback from either a client or an advisor about option strategy not performing well or not doing what they expected, it's always interesting to me. Let's say they have a bad experience with options. And what's funny about that observation is that if somebody had a bad experience with an option, the person on the other side of that contract had a good experience. And that's always what's interesting about options to me, is that it's not the option's fault what it did. It's the premise that the person who bought it or sold it had, and it didn't work out that way. So that's what I think is interesting about options, is they just add such an amount of control if you're on the control side of the equation, or a tremendous amount of risk if you're on the obligation side of the transaction. So that's pretty fascinating. But
you're absolutely right. I mean, options are really a tool, and you can use them for a variety of objectives. So the basic building block is the call, which gives the investor the right to own something, or the put, which gives the investor the right to sell something. But you can use these tools to define the kind of risk and return you want, or your client wants, from an investment. And what makes this so powerful is that you can actually create an asymmetric return. You take an exposure to the S&P 500, and you can actually truncate the downside participation and enhance the upside participation by designing an options-based strategy. Once again, the advisor or the individual investor doesn't have to be the expert necessarily. They can defer to an expert like yourself that would implement those types of strategies.
Right. Well, for instance, the same thing can be done. You talked about an asynchronous payoff where you can basically invest money into options and enhance the return of a portfolio and still define a drawdown risk. Alternatively, you can choose not a speculative side of things or not something that's based on growth, but you can choose to create an income component out of the same products. In fact, even the same option. But if you're the seller of that option, now you're in a situation where you're generating income for the portfolio, but you've now done an asynchronous payoff the other way, where you actually are limiting what you can earn and still taking full participation to the downside. And then it gets more complicated. You can layer in additional layers of options to truncate that downside and still have income. It's mind-boggling, really. And I think that's the big drawback or maybe a hurdle for many advisors, is that they just start to look at the way you can spin an option construction around a portfolio or in a portfolio or, as part of an allocation to a portfolio. And wow, it really can get complex. In fact, I think on your cboe.com website, I think there's a list of all the possible types of transactions. Does that exist on your website? Like whether it's a spread or a condor or, a butterfly or all those kinds of things?
Yeah, there's Cboe created a variety of strategy benchmark indexes. Mm-hmm. And these are indexes that are intended to measure the performance of specific strategies. So we talked about the buy rights. We have a buy rights index on the S&P 500, the Russell 2000, the MSCI emerging, and EFA indexes. These benchmarks have been very helpful to provide education, but they've also been very helpful to demonstrate use cases. And so BXM is the ticker for the S&P 500 buy right. This is looking at a near the money call. So the underlying holding could be the S&P 500 mutual fund. It could be an ETF. It can be a portfolio that has a very high correlation to the S&P 500. And then you can sell our cash settled index option, the SPX, or XSP, which is the mini index, against that holding. What makes this benchmark interesting, it's systematic. So every 30 days, this position is rolled. And, I can go into very granular detail about why an investor would want to do this. We're looking at options from the perspective of not only the ability to buy or sell, but also the expression of volatility. And built into the pricing of options is several volatility components. Looking back, the 30-day historical volatility, and looking forward, the 30-day expected volatility, and the difference between the implied volatility, the expected, versus the realized, we call that the volatility risk premium. And there are times where there's tremendous bullish sentiment in the market and the volatility is pumped up, creates an opportunity to sell a call while you're owning the underlying. So we talked about BXM. We have variations of that. We have a 30 delta buy right. We have a conditional buy right. And so these are, strategy benchmark indexes that one can go to our website and look at the methodology and look at the historical pricing. So BXM, for example, Cboe.com.
I'm going to stop you right there, though, because I think this is part of the jargon that we get caught into with particularly, I think if you're maybe a seasoned option trader, then some of the things that you're saying are going to resonate and make sense. But I'm a little concerned that if you haven't got any experience with options, that last 2 minutes might have been like, okay, this is why I'm not trading options, because it's completely complicated. So let's try and break this down a little bit. The main thing to think about is that on an equity of any kind, whether it's an index, tradable index, like maybe a Vanguard or a BlackRock S&P 500 index ETF or mutual fund, the investor has the choice of buying it and then wait and see what happens. And then there's no time limit. They can just buy it and sit on it, and it'll either go up in price or go down in price, or some of each, some a lot or a little. And then at some point, they can make a decision to either exit some or all of that position and move it into something else and move around. So that's basically it. You have a very, very what we would refer to as one-dimensional up or down is really the number. And I think what's really challenging for a lot of advisors initially, and for the clients for sure, is to get the idea that with an option, you're not only picking the direction, but you can choose to be either for or against the direction you're picking. And that can be done through the form of the puts or the calls. And then we have to add another component, which is the actual amount of time we have, because these are contracts. They're not actually equities. They're contracts on something else. So that time value, there is a cost for that time value, but the time itself is a thing. So, we used to have only quarterlies or something on the S&P, and then it started to be, we got maybe some monthlies, and now I think it's daily, right? You can actually buy options with very, very short duration expirations down to the very granular level. But the point is, if you buy a 1 month option, you've got 30 days to figure out what to do with it. And here in the United States, American style options can be exercised anytime during that period and or sold. So you're really just holding a piece of paper or contract that says I get the ability to control 100 shares of something for a single option contract. Or if you've sold the contract, which is also referred to as writing the contract, you are obligated to do whatever you said you were going to do. Excuse me. So if you have sold 100 shares of the S&P 500, for instance, and were paid for that, you've got to deliver it at the price you agreed to deliver it at some point during that 30-day period. So that's the basics of the option contracts. From there, now we have to deal with strikes. So if the underlying security is trading, let's say at 400, you have to make a decision on whether or not you want to be at the money, or what's the ATM type of acronym, and that would be around 400, or you would be out of the money, OTM, which would be above that current price if it's a call, or it would be below the price if it's a put. So again, what it is can change on whether it's a call or a put. And this is where we start to get into the complexity of option trading. And it's, I think, large measure why we you probably have a better understanding of what type of penetration or usefulness is options, let's say, in a standard. Do you cover both RIA and broker-dealer relationships, or what type of distribution channel do you work with?
Primarily RIAs and family offices.
Okay. So in the RIA and family office space, which is appropriate for our audience, what percentage of those out there do you think are using options not as a accommodation for one or two clients, but actually as part of either a sleeve or a recommended thing that they would at least have in their tool chest for people? Yeah,
this is an interesting point. And I don't have hard facts, but there's been a number of studies. Cerulli did a study in 2017, and there is an investment advisor association that tracks, based on a survey, what percentage of the advisors are using options. And it's not as much as you might think. It's about 30%. Okay. So options are a great way not only to deliver value to a client, but it's also a great way to differentiate your practice, because the vast majority of advisors simply aren't embracing the benefits of using an options-based strategy.
Yeah, I can imagine. I mean, it's basically, as you know, we're all in. We have our primary portfolio, measured risk portfolios, is option-based. And so we're a huge believer in the structure that it can bring, particularly in risk management, and the ability to be able to sit across from a client or have an advisor help their clients understand that there is a defined amount of risk in the portfolio and that it's actually calculatable. Before you have a bad experience, you can know what it is you're risking. And we think that's a really strong thing to have. And it gives the clients and the advisors who we partner with the ability to help a client really define what that risk is going to be before the risk materializes. Because I tell you one thing, we've been doing this for a long time. And before we were using options, if we had an asset allocation model built off of the assumption that we were going to be investing in different asset classes that historically have had different behavior patterns during the year, what we find is that when a crisis comes along, whether it's the tech bubble in the early 2000s, or it's the financial crisis in early '08, or it's the pandemic in the 20s, or this interest rate crisis that we've just been going through or still kind of going through right now, a lot of those asset classes that we thought would behave a certain way tend to change their stripes. And they maybe can start to lose money where we didn't think we would lose money, or not perform strong enough to the upside or the downside, depending on what position you put into the portfolio. And if you find yourself with a portfolio that's declined, 14% or something, and you were expecting only 10, and you get a client phone call and they're like, well, what's going on? What do you think is the downside here? The real challenge is, in the absence of an option-based strategy, there's kind of a hope answer rather than a math answer. And we just want advisors to know that through the use of options, there is a much more granular way of building defense, or being able to answer that question with more confidence. So that's really the mission that Measured Risk is on. And I know that you also, the Cboe, are definitely interested in helping advisors figure out how to implement strategies that can bring those either income objectives or risk metric objectives out to the public. So that's important. So why do you think, what are your thoughts on that 30% adoption? Is that lack of education, lack of desire, or just the market doesn't know that it's out there?
I think there's conventional thinking. And I think most advisors start off the relationship trying to understand their client's appetite for risk and what their investment goals are. So oftentimes that begins with a survey or a questionnaire. And from that, an investment policy statement is derived, which then feeds the portfolio allocation decisions. So if a client is willing to take more risk, then there's a greater allocation towards riskier assets. Equities are considered a risky asset class. You look at the S&P 500, the broad-based U.S. index. Over time, the annualized return is roughly 7%, and it has a standard deviation of about 20. So your clients are looking at potential movement, and this is what we saw in 2022. The S&P moved down by almost 20%, and so the buffer, the 40% that was allocated to fixed income, wasn't quite there, because what was considered a non-correlated asset became correlated. And when interest rates are roughly 1.5%, there really isn't that much of a cushion. So I think advisors are starting to look at this 60-40 portfolio mix and wondering what can be done to maybe provide a greater buffer, or perhaps allow for optimizing returns by having greater exposure to equities and having something in place to hedge against downside price risk. And I think that's where education comes into play, because that type of strategy does exist. I just came from the Investments and Wealth Institute conference. A lot of talk about shifting from 60-40 to 80-20-20. 80% equities, 20% fixed income, 20% alternatives. Alternatives can be expressed a number of ways.
Well, hold on. I got to jump in. You did say 80-20-20. That's 120.
I'm sorry. I'm sorry. 60-20-20. Sorry about that. 60-20-20.
That is some fancy math, I got to say.
Yeah. Sorry about that. You're absolutely right. 60-20-20.
Mm-hmm. So it's an interesting approach, but I'll just do a small plug here for our firm. We're of the kind of observation that all of these, really what it boils down to when you do a 60-40, 70-30, something other than 100% equity, is that the long-term rate of return of, let's say, the S&P 500 is pretty much the 800-pound gorilla that most advisors and managers are trying to benchmark to and either stay close or something close to it. But very few clients, except for the youngest, really are able to really withstand the volatility of being in that fully, because the risk of a drawdown event, we all know is something 50% would not be out of the question at all in a relatively short period of time, and maybe worse. And that's one of the challenges of any data set, is that that's only the data we've had so far. It isn't the data. It isn't what can happen. It's only what has happened. And that's another really important thing to think about with any kind of portfolio construction. no matter how good the algorithm or how sincere the data and how well scrubbed and intentioned, all of these patterns are just patterns that have been observed through either artificial intelligence or real people, looking at something to come up to arrive at something that looks like it's going to be able to weather a fact pattern that already existed. But it doesn't necessarily give us the outcome we want in the future because, future hasn't happened yet. So we don't know how the future is going to come out.
This is
areas where I really love the effect of an option, because an option contract is a contract. And if you're the buyer of that contract, you have rights that have been defined in the contract through the strike price of the security that it's underlying against and the duration of the contract and what you've paid for it. And so as soon as you enter into an option contract, you have known outcomes, possible outcomes. You don't know what will happen, but you know with much greater certainty what your outcomes can look like. And that's the huge differentiator that I really encourage advisors and retail clients, if there happen to be any watching or listening here, that with an option contract, you start to define certain outcomes. You know going in what your cost is, or going in what your risk is. And you can make an assessment about whether or not that makes sense or not. Really anything else, the only tool you've got to defend yourself is either to own it or not own it. So literally it's a matter of either buying it or selling it. And those are such limited choices that I really am a fan or a cheerleader for people getting into the understanding of how options work and how they can bring clarity and confidence, or frankly, terrifying fear to your portfolio if you take the wrong side of an option contract. So I think that's something that lay people or even advisors, if they haven't been paying attention, could sort of step into a behavior, do something with an option contract, have a successful outcome and go, oh, that was easy. And then repeat it again without really understanding what that option contract might do if it doesn't go the way they thought. And you can really end up with some highly levered results that maybe weren't what you had in mind. So super cautious that you do have to treat an option contract almost like a cobra. It can turn around and bite you if you don't know what it's capable of. So for sure, you have to know going in what it is that it's capable of. And there are tools like, do you have an option calculator on your website? I think we can bring up the Cboe here.
So Cboe has on its website a number of tools. One is an options calculator.
And where is that? Under education, or is it under?
Under education.
Under education. Okay. So if you're listening here, we're going to cboe.com, and then there's an education tab. And then is this the practice tools link? So
if you were to drop down from tools and scroll down, there's an options calculator.
I'm in education, and then I go to option practice tools.
Yes.
Right. So in the tools, it shows nifty gizmos to help you trade smarter, which is great. And then if I scroll down from here, I see there's an options calculator. And the options calculator is going to help us understand what the cost of options trading.
What it does is it uses the Black-Scholes options pricing model.
Okay.
And you can plug in the variables, and it will tell you what the fair value is for that particular option.
So do I have to know what the rho and delta and theta and all these Greeks, or is it going to tell me based on what I'm putting?
It will spit that out.
I see. So the variables that I'm looking at, I see. Okay, so here's your start time, option strike, and strike price and whatnot. I get it. All right. So what we're looking at on screen, if you're listening to us, is the ability to enter data on the expiration dates and interest rates and theoretical safe money values, and then calculate some of these, what are referred to as the Greeks, which will help measure the effect of things like time decay. We should mention that when you buy an option contract, there is either, depending on how much time there is in the contract, there's a significant amount of money that's attributable to time. And that time value will erode under a theoretical, this is Black-Scholes model, the theoretical decay of that time value. Because, for instance, the easiest way to describe this is if I buy a movie ticket and my movie is going to be playing tonight at 8 o'clock. Right now, for me, it's about 1:30 in the afternoon. My movie ticket still has its value, but by about 7:55, that value of that movie ticket's getting less and less valuable because I need to either use it or it's going to become worthless. Because tomorrow, by let's say roughly 8:30 tonight, and certainly by tomorrow morning, my movie ticket for last night's movie is worthless. And the same is true of an option contract. So people might not think that they have experience with options, but you really do. If you've ever purchased a ticket or you've made a reservation, that reservation has value up until the point the reservation time has come and gone, and then it has no value. So very similar kind of relationship. So the other thing that the Cboe site has here is under the education section. Let's go.
Scroll down. You'll see trade alert.
Trade alert. Let's see.
You may have to go back.
Okay, let's go back.
And scroll down.
So then I go back into practice tools, scroll down, trade alerts. Okay. And the trade alerts can be built also based on strikes and underlying.
So trade alert is actually highlighting some of the large volume trades.
Oh, cool.
It could show like the options that had the greatest increase in volume, the greatest decrease in volume, greatest increase in open interest or decrease in open interest. So the user can put in parameters or filters, and trade alert will spit out data based on the user's parameters.
And what I'm looking at right now, I assume you can see our screen too. Is this showing me that Sirius XM was a big mover today?
It's showing you a trade was canceled.
Canceled. Okay.
Yeah.
Interesting.
So the user then, they can put in whatever the filters they want to spit out the kind of information they're looking for.
So where does this actually show up, though? Do you have to subscribe in order to have this happen, or where do you log?
For trade alert, I think you have to subscribe for that for the real-time data. The next one, if you go back, the next item that I think is really very interesting is the trade optimizer.
Okay.
And if you click on that, for those who are, let's say, neophytes, and they have a view on the market, let's say neutral, you can plug in a ticker. Up above, you see Cboe is the symbol input, but you can put in...
Use SPY, for instance. That's the big S&P 500 ETF, tradable ETF, currently trading at about $412 plus or minus. And so the default expiration is today, but let's say we take it out to September, end of September. And this is giving us just various outputs, right? So it's saying that if we want to buy a put spread or selling a put spread or buying a call spread or selling a call, these are the various P&L for profit and loss illustrations and the cost.
That's correct.
Return, right. So what's interesting about this, if you're not watching when you're listening, is that there are things you can do here, like buying a put spread, return at a target price can be, what you spend $2.16 with a potential 131% return over this time period if the market goes to a certain thing. Right. So that's what's amazing to me is that the inherent leverage in small dollar transactions, relatively small dollar transactions, and what's possible. And you have to have a premise. You do have to have a decision or an opinion about which way the market's going to move. So if you think the market's going down, you can build a trade to benefit from that. If you think the market's going up, you can build a trade to benefit from that. And if you think the market's going to be neutral and just hang out for a while in a certain place, you can build a trade that'll be profitable for that. And again, a lot of people, particularly novice investors, have a hard time understanding this. The best example I've come up with is the idea that most people that we work with in financial services have been able to purchase a home. And in most cases, they haven't written a check for the whole house. They've actually put a deposit down on the house. And so think about the inherent leverage in the deposit kind of illustration for a home. Let's say you take a $500,000 house and you only have to put 10% down, so it's $50,000. And that's your equity in the house when you're done, and you've borrowed $450,000 to buy it. If the house moves up in value 10% over the next X months or a year or so, your house is now worth $550,000, but the equity in the property, that $50,000 that you invested, has actually got a 100% return because your $50,000 equity has grown to $100,000. So this is the idea that is really fundamental to options, is the ability to have a small amount of capital, in this case, the $50,000 down payment on a house, control a much larger asset, which in this case is the $500,000 value of the house. You can do a similar thing with the option contracts where you have a small amount of capital, in this case, on the first put spread, $2.16. is controlling $400 worth of individual share value. And that's a huge, that's basically, a 5% type of capital commitment. And that's where you can get some really tremendous movements if the market goes the direction that your option contract construction is designed to benefit from. If it doesn't go that way, and you're the owner of the contract and not the seller, then your loss is limited to what you've paid for your option contract construction, whether it's a single contract or a spread or a whole bunch of option contracts in a more complicated transaction. So you can build it in a way that you know what your risk is going in, and you can have a very asynchronous return structure going out. How'd I do? Rick, is that about summing it up?
I think that's fantastic. You think you did a great job. One thing that we didn't cover, and unfortunately we're almost out of time, I think it's important to note that options are really very effective for managing risk. And we did not really go into detail on a collar, but a collar strategy allows the investor to hold on to a position, not sell it, but hold on to a position. For example, we're coming into a period of time where Congress has to decide whether they're going to raise the debt ceiling or not. It may create some uncertainty, it may create some more volatility. And investors are becoming less comfortable maybe having the exposure to equities. One way to address that is to sell the stock, but then you incur capital gains potentially and taxes on capital gains. The alternative is to protect your equity position, and you can buy a put or you can put on a collar, which is another way of saying you buy a put and then you sell a call to finance the cost of the put. And there are variations of that strategy that can be very effective, putting on a hedge for the specific time period where you want that protection.
Absolutely. And I think we use this in our practice a lot to help people with coming up with like a tax realization budget. So we may bring in a client's portfolio that has some long-term positions that have very low cost basis and have appreciated a lot over time. But they recognize that that's not necessarily the safest place to be because they have a concentrated stock position. They'd like to take advantage of what we're offering, but they're really kind of trying to manage the tax liability. And what we're able to do is build those collars and have a discussion around, how much tax budget do we have annually to maybe work ourselves out of this position over, could be 5 years or 10 years. It doesn't have to be right away in order for us to start doing that transition. But we can bring to bear the immediate defense of, as you're saying, this collar. And what this amounts to is, stock trading at 100, we end up maybe selling a 108 call to bring in income to then finance the purchase of maybe a 92 put. And then we could get more fancy and maybe sell a call spread that is less expensive, but still allows maybe potential for a runaway upside, or potentially only buy a put spread by selling another put below the first put to reduce the cost of the put and allow for a big chunk of the potential loss to be buffered out and still generate net income on the call side, or move the strike further away so we don't have to have the risk of being called out. The point is, in the hands of a seasoned option advisor, there are a number of very significant resources that can be brought to bear for those concentrated positions or just in a retransitioning type of experience. So good point. Excellent point. Also, Cboe, every document we have is going to suggest that options are not suitable for all investors. You really should work with either a qualified person to understand what you're doing to make sure you don't hurt yourself. And I think that's an excellent way to get to the end of our show. So, Rick, thank you so much for sharing your time with me today. And if any advisor wants to reach out to you directly, is that something that they can do? Are you available for direct consultation or? Absolutely.
I encourage them. My email address is rrosenthal, Rosenthal, at cboe.com. Okay. And Larry, thank you very much for inviting me to join your podcast. It's been a pleasure.
This interview also may contain statements that constitute endorsements of measured risk portfolios, also known as MRP. Please note that any such statements are not made by clients of MRP, but by representatives of other investment advisory firms that work with MRP. No compensation was offered or given in exchange for these statements. However, a conflict of interest exists due to the incentive to give an endorsement in the interest of a good future working relationship between the endorser and MRP.